Hi, I'm Bruce Six, Chief Investment Officer for Mid-Atlantic Corporate, and this is the economic update for April 2014. Today we're going to talk about Janet Yellen's statement and some of the changes that were made there. We'll talk about the weather and what impact that could have on the economy. We'll also talk a little bit about the impact of the situation around the world, what this all means for credit unions, and of course we'll finish off with April's data releases. At the March 19 FOMC meeting, the committee made some adjustments to the language, taking out the unemployment rate target of 6.5% and replacing that with language that says, considering a wide range of information, which includes labor market conditions, the financial markets, and inflation expectations. So the Fed has given themselves a little bit of latitude there. The Treasury curve really didn't react. The Fed continued to taper by $10 billion, so tapering was expected. This change from the 6.5% was widely expected because we were getting down to 6.5% and the Fed wasn't going to be moving. What wasn't expected was Janet Yellen during her press conference after the statement release saying that in her view the FOMC would be looking to move the Fed funds rate approximately 6 months after tapering had been completed. Well, that is supposed to happen in October, so the first Fed funds rate change would have been in the first part of 2015. Well, that's ahead of where the market was thinking. So now Janet Yellen has come out. She's softened that a little bit. She's backpedaled a little bit on that 6-month period. But right now, people are still expecting the FOMC to change the Fed funds target rate in the middle of 2015, not the first part of 2015. So everybody knows the weather was horrible across the nation over the wintertime, really all across the country. The Northeast was cold. We're used to cold, maybe not this much cold, but we're used to the cold. But the South got hammered. They are not prepared for the cold. The ice virtually shut down some of the major cities in the South, and agriculture in the South is being impacted. So we're seeing a lot of the growing seasons be slower to get started. So that's going to cause some issues. Also in the West, we have severe droughts that persist out there, and that's going to have a negative impact on agriculture. So as we get into the mid and latter part of 2015, expect to see grain prices go up, corn prices go up, and that's going to take money out of the economy as people are spending for necessities. Consumers won't be spending as much money, keeping the economy going, so it will be a drag. We don't know how much yet, though. That's the key to look for. So when we look at the impact of what's going on around the world, we have the Russians and their standoff with the Ukrainians, the Russians taking Crimea, but it does not at this point appear that it's going to go any further, which settles everybody else around the world down. In Europe, the economies there are limping along, but there's not any talk about the Eurozone breakup that we were hearing a year or two ago, so that's kind of gone away. And in China, they are slowing dramatically. The Chinese government is now looking to put some stimulus in place. That has a huge impact on us because China is a very large trading partner for the U.S. So all these factors need to be considered as we go forward. So what does this all mean for credit unions? Well, with that expectation that FOMC is not going to be moving the rates until the middle or latter part of 15, should give credit unions a little bit of room for those shorter average life loans to really be able to put them on at fairly aggressive rates, so get loans on the books. Auto loans, great assets for credit unions to look at. I am a big fan of used autos because there's very little competition from the dealers, and the collateral is going down the depreciation scale a little bit, so it tends to hold up in value. When we look at the real estate side, we are hearing from a lot of credit unions that they are getting strong demand on the home equity line of credit or real estate equity loans. I'm partial to home equity lines of credit simply because they don't have the interest rate risk because they're variable rate, but real estate equity loans that are 10 years and in are pretty decent loans on the books. The average lives come down, and even though, yes, there'll be lower rates when rates start going up, you have some time on that. Now, longer real estate equity loans, say a 15-year fixed rate or real estate equity loan, that one you might want to not price as aggressively because that could pinch a little bit when it comes to income a few years down the road. So be cautious on that. Looking at April's top tier data releases, we have the unemployment release on April 4th. We also have the personal consumption expenditures release coming out on April 30th. And the housing market release is coming in the latter part of April. That's the economic update for April 2014. Make it a good month.